We just had the GDP data. We're officially in a technical recession. We had the inflation announcement a couple days ago. We've had Apple earnings. We've had Microsoft earnings. It's been a massive week. It's been one of the biggest weeks in crypto in a long, long time. But what does this mean for crypto going forward? It's time to step back after a crazy week of news, after a crazy week of announcements, price action, and speculation, and have a look at the month of August, have a look at what we have in store for us in the near future, and look through some of the key data that was revealed this week to give us an insight into where the crypto market is going. Without further ado, let's get straight into the show. Overnight, we did have some big announcements. We had the Apple earnings announcement. Apple announced that their Q3 earnings per share was $1.20. Their estimated was $1.16. So Apple actually beat earnings. There's a lot of speculation that if Apple actually missed earnings, obviously this would reflect negatively on the market. But positive earnings for Apple is a positive earnings for the market, considering Apple takes up such a large percentage, being the Nasdaq's biggest stock. Bitcoin, being so correlated to the Nasdaq, does rely on the price performance of these major companies to perform. So it's good that we got those earnings in the positive for Apple. I'm an Apple holder as well, so that was very nice to see. Amazon actually missed earnings. It joins a long list of companies that missed earnings, like Google, like Microsoft, like Meta, who also missed earnings, but it was only a miss of 12 cents per share. Their revenue was actually up just slightly, which I think softened the blow a bit. And we saw after market, the Amazon price actually went up 10.49%. So despite slightly missing earnings, the market was pricing this in. And this is basically the story of the entire week. Missed earnings after missed earnings, and then huge rallies preceding those earnings, because the market clearly does price in this uncertainty, and it was pricing in a worst case scenario in a lot of these cases. So Amazon, another case of a miss of earnings and then a pump after market. But definitely the biggest news overnight was the GDP. The biggest news, although the earnings are very big for the Nasdaq, I think the GDP may have been the biggest date for this entire week. And the GDP actually indicated that the US is now in a technical recession. I'll get into a minute what that means for the future of equities, considering we can look at past recessions to verify how similar this recession is actually looking. But coming in at minus 0.9% for the quarter was actually below expectations of plus 0.5. So even though we missed expectations, even though the economy shrank 0.9%, and a lot of people, including JP Morgan and Goldman Sachs, were expecting positive growth on the quarter, Bitcoin continued to defy the odds and rally. We actually bounced off this range high at 23,000, continued to make a push to the upside, which is now a 3% move. Altcoins are up 10% plus. Ethereum's up 5%. Bitcoin does not care about these announcements right now. And Bitcoin is continuing to push higher and higher and higher. And bullish continuation is occurring right now with the test of the $24,295 level. But why would Bitcoin be rallying, even though it's got bad news after bad news after bad news, missed expectations, technical recession, even though there was a chance that we aren't in a technical recession? Well, it's for one reason that Gareth Soloway actually points out quite well, I think. He says GDP came out at minus 0.9%. Markets initially sell, then rally as investors love the falling dollar and the likelihood that the Fed can no longer raise rates aggressively. So it's risk on for now until the market realizes the Fed can't print us out of a bad recession. And I would agree with him. We are playing a game of chess. We've essentially checkmated Jerome Powell and the Fed because they cannot pivot. When we are in a technical recession, because the GDP data was so bad, they now don't have license to do any crazy aggressive rate hikes. And we know that Bitcoin thrives in a low interest rate environment. So the fact that they cannot do any crazy aggressive rate hikes to further increase the cash rate is bullish from a Bitcoin perspective and an equities perspective, at least in the short term, because it does put a slight damper on interest rates. Now, since Bitcoin performs in a low interest rate environment, people are taking money, and not just Bitcoin, equities as well, taking money out of the dollar and putting it into assets like Bitcoin. And essentially what this has resulted in is actually a falling of the dollar, the DXY, after weeks and weeks of basically the DXY going on a tear and the dollar index being very strong, not only against equities and cryptocurrency, but also other currencies. So the Federal Reserve is hampered right now. And I think the markets are obviously forward looking. So even though on surface level, these announcements weren't great, obviously we never want to be in a recession. Obviously we never want major companies missing earnings. The fact they can no longer raise rates aggressively, I think is a massive factor. And it's one of the main contributing factors behind why we got this rally over the last couple of days. I guess the question is, will this Bitcoin rally sustain? Well, I think the single most important chart in crypto right now is actually this DXY chart. Now, this is quite a damning chart because although we have the long-term support down the bottom here, we do have a 2-month support trend that it is just broken out of. Now, the DXY is currently bouncing off the 200 MA, which has confluence with horizontal support at 105.9. However, it is looking increasingly weak, and it continues to make lower lows here on the 4-hourly chart. So we can see this is the DXY, the strength of the US dollar. This is the trend line plotted in versus the EMAs, and we can see that we just broke. Obviously, we do have the 200 MA and horizontal support here, but it's looking increasingly weak. The RSI is kind of lingering at the bottom here. Maybe a short-term bounce above trend, but it's still looking very, very bad for the DXY. Even on the daily, we are seeing a clear break of trend. And, if we go to the weekly, we are also seeing a break of trend with the MAs, quite far below at this long-term support range. So if the DXY actually did take a massive hit, that would be kind of the trigger for me for Bitcoin to push up to this 28K region, because a lot of us are looking and now targeting that 28K. The reason everyone seems to be targeting 28K is because there's actually not much in the way here in terms of liquidity blocks. Like there isn't too much resistance from the 25K mark up until the 28K mark, which means there is a bit of leeway for growth here. There's a little bit of headroom. We haven't had headroom in the market in quite some time. I think that's the major thing right now with FOMC 55 days away. August is looking a little bit better, at least, than July, for the pure fact that the announcements are behind us. Some of the volatility that came off the back of those announcements are behind us. And Bitcoin has a little bit of leeway here to keep its trend, or at the very least, create a trend. Because at the moment, it's been very hard to get a clear trend out of the Bitcoin price because there's been announcements which have clearly manipulated the price. Massive pumps through huge areas of support, of resistance, huge bounces of support, massive swings and reversals. We saw obviously bullish continuation, then a bearish reversal, almost looked like a letter M shaped or a head and shoulders pattern back down to the range low. All of a sudden, reversal after the Fed data came out. And then now we're testing the 24K region again. So it's extremely volatile. I am looking forward to August for the pure fact that we don't have as many. Now, there is still obviously housing data to come and some minor data sets, but you don't have 10 of NASDAQ's top 20 companies all announcing their earnings in 2 days. You don't have the GDP data coming out for the quarter announcing the beginning of a technical recession. And you certainly don't have a 75 BPS rate hike considering the next FOMC is 55 days away. So we do have a little bit of leeway now, which is nice. I feel like I can breathe. It's been a crazy week. If you guys were trading this week, you would know that. We actually did very, very well off our trade from 3 days ago. We got Bitcoin. I don't even know how we did this. Tricky and I did this. It was probably one of the greatest bottom calls ever that we got to the 20,800 and we wrote it up. I actually did cash out a portion, somewhere in the middle and then another portion at range high. So I missed out on the last 10%, but that was a solid 150% profit there. And on altcoins, it was even more. So congrats to anyone that got on that. We actually did it on Instagram. You guys know I trade live on Instagram after each show, hang out with you guys and answer questions. So sorry, not all of you were there because obviously, I tend to reserve some of the trading stuff for Instagram because this show is primarily, focused on the market, investments, etc. But yeah, I do go live there after every single show. So if you ever want to stick around, ask questions, do some trading, hang out a little bit, you know exactly where to go with that link in the description. But yeah, the Bitcoin price is absolutely pumping. And this is kind of crazy just to put it into perspective. 9.1% CPI, 75 BPS rate hike. Microsoft, Google, Amazon missing earnings. Apple made earnings. A couple companies made earnings. Meta missing earnings. Technical recession confirmed. Bitcoin bullish. So if you had told me at the end of the week, we would have missed expectations on the recession. We would have missed expectations on 3 of the top 5 companies in the NASDAQ. We would have gotten a 75 BPS rate hike and a 9.1% CPI. I would have laughed you out of the room if you told me Bitcoin was 24K. However, I think the markets are responding for very good reason, as Gareth Soloway pointed out. And although a lot of us were probably anticipating some bearishness going into the week, I think the clear sign was actually 3 days ago. And I said this on the show a couple of days ago that I'm feeling bullish, and I woke up feeling bullish. And I feel like this uptrend will continue because the second Jerome Powell came out and had a dovish undertone to his announcement, that was the second that I realized that the markets are forward looking and they're going to disregard basically any announcement from here. Because Jerome Powell's dovish tone basically dictates the entire market. He basically indicated, without saying that they're stuck, and that they couldn't raise rates further. Very, very interesting. I'm going to get into a couple key facts about this recession that's different to other recessions. But firstly, make sure if you do want to sign up, there's a link in the description to a ByBit account if you want to trade, you want to take advantage of the volatility, or even if you just want to trade spot. ByBit is a great exchange to do so. And you can take advantage of a $4,200 sign-up bonus, as well as the weekly giveaways on the main show, which you could potentially 10x your account. I think we've 10x multiple accounts over the past few weeks. Some very lucky winners as well. So yeah, link in the description for a ByBit account if you'd like to sign up and trade. And yeah, that's that. Let's get into some of the key stats that I'm seeing in terms of recessions and why this one may be different from the others. So we are now in a technical recession. There is a difference between a technical recession and a recession. The key difference is a recession is a recessionary phase that sustains for a considerable length of time. So there's no definitive time limit on what a recession is versus a technical recession. Whereas the technical recession is a technical term for a back-to-back decline or a consecutive decline for 2 quarters consecutively of negative GDP growth. So 2 consecutive quarters of negative growth in the GDP is technically a recession. The US came out last quarter, announced that they had negative GDP growth, and then they came out yesterday and they announced a minus 0.9% GDP growth, which technically puts us in a recession. Now, it's kind of comical in my opinion because there's been lots of controversy about the Fed changing the definition of a recession. Biden said we weren't in a recession. Jerome Powell came out yesterday and said we weren't. Technically, he was being cheeky because at the time we weren't, at least for the next 12 hours. And then, look, there's been a lot of speculation. I think it's kind of stupid. They're just playing games, basically. The government right now, they're just playing games in terms of what is and what isn't a recession. Let's be honest, though, it doesn't really matter what a recession is. The definition of a recession, in my opinion, is arbitrary because a recession is a reflection of economic activity. It's a reflection of unemployment. It's a reflection of the health of the economy. If the economy's bad, it won't make a difference whether we tick over into the technical recession buzzword for the media or whether the economy is actually struggling. So in my opinion, it's arbitrary what we call a recession and what we don't. If it's around the mark of negative growth and the economy is definitely showing signs of slowing, then that is bad for the economy as a whole. And I think we're in a little bit of a bubble as investors because we are obviously, keeping our eyes on these assets, Bitcoin, Ethereum, the stock market. We kind of have tunnel vision in terms of tracking these assets. We don't really realize what happens on a fundamental level. So although Gareth pointed out, that markets actually will like this recession news because of the Fed not being able to raise rates aggressively, we have to think from a grassroots level of the average US citizen and the average citizen around the world that are actually going to feel the effects of inflation and are actually going to feel the effects of this recession, however long it ends up lasting, whether, we print another quarter, or whether it ticks positive. These people are the ones going to be feeling the effects. And I do think it is difficult to sugarcoat a recession for the fact that discretionary income or disposable income is such an integral part of the crypto ecosystem. That's essentially what drove the whole retail bubble, I guess you could call it, last year, or the bubble inflow of liquidity. It was having that retail with disposable income from the stimulus checks. And before inflation was too bad and the price of goods was manageable, they were putting money into crypto because they had more disposable income. I think now what we're going to see, this is more of a long-term reflection of a recession. People have less discretionary income. They have less disposable income. And it certainly takes a hit on the retail level of crypto because goods and services are going up. I don't know if you've been to the petrol station lately. I don't know if you've been supermarket shopping lately. I know most of you probably have. It's getting crazy out there. Life is becoming expensive. And maybe it doesn't impact you that much. And it doesn't really impact me that much in all honesty, but we have to just accept that recessions impact a lot of people. And unfortunately, it's the poor that are impacted the most. It's not the wealthy or the well-off. And it's certainly not the one with assets, but it's the people, at the bottom of the pyramid that actually suffer the most. And that does have knock-on effects for markets. Like, we can't sugarcoat the fact that it has knock-on effects, but I think we have to look at previous recessions to actually see what those knock-on effects can be in terms of price performance. Now, Rand did a show on this a few days ago. I did a very concise summary of that show and a concise summary of the last 5 recessions, so we can actually start to pinpoint. I just dropped my headphones. So we can actually start to pinpoint what recessions will actually look like. So that's my definition of a recession. Now, the first recession, so I'm just going to go through 5 quickly. The last 5 recessions, 1980 to 1982. During this period, there were 2 recessions, the worst of which came in 1982. This recession was the most similar to the situation we're finding ourselves in 2022 in terms of the Fed's response. Because what actually happened in 1982 was the Fed was playing this hot and cold game, this stop and go policy of being super aggressive, that's super lenient with monetary policy, pumping money into the economy, pulling it out, pumping money, pulling it out. So when inflation got too high, they'd aggressively raise rates, and when inflation got too low, they'd aggressively do the opposite. So what ended up happening was they got caught out in 1982 because unemployment started to rise alongside inflation. Now, when unemployment starts to rise alongside inflation and you raise rates, then you're not solving the problem of unemployment. You may be solving the rate problem, but the labor market has significant consequences across the whole rest of the market. So the problem they found themselves in was this stop and go game. Eventually, they got caught out. Although it worked for many years, for the late 70s, from 1975 to 1980, eventually they got caught out with this policy. And what it resulted in was 2 major recessions, the worst of which came in 1982. And the Fed was trying to raise interest rates to tame inflation, but due to the high unemployment numbers, it actually ended up backfiring and causing more issues across the manufacturing and construction industries, which led to huge supply issues on the supply side. And it then had knock-on effects into real estate and the banks, and then it kind of all spiraled out of control for a period of 22 months. And a 15-month recovery is what it actually took from start to finish of the recession. Now, the recovery data I'll be mentioning in this video is the previous peak to the reclamation of that peak based on the S&P 500 and the NASDAQ. That's the definition I'm using for a market recovery. Now, this sounds very similar to the current scenario because what caused the 1982 crash was the Fed raising rates to tame inflation. That's exactly what they're doing right now. They're raising rates to tame inflation. Now, the way we got there is very, very different. The way we got there this time, although excessive money printing was a factor in the 80s, and I obviously wasn't born in the 80s, but I've done my research, today, excessive money printing is what caused high inflation. But what caused high inflation was off the back of the pandemic, basically a black swan event, which required, and there's debate over to what extent it required this, but required some sort of stimulus. Now, obviously, the Federal Reserve took this too far with their lenient monetary policy, and that resulted in very high inflation, and now they have to raise rates in order to tame it. But it's similar to 1982 in the sense that the recession was caused by the raising of rates themselves, which is essentially what is happening now. It sounds familiar, but the way we got there was very, very different. 1990 to 1991, this was similar to the 2020 crash. Very quick V-shaped recovery. It took 9 months to recover. The market only dropped 25%. It was basically bang down, bang up. It was a quick flash recession, and then we were straight back up. 2001, this was a pretty bad one, at least from a tech stock perspective. Obviously, what happened in the late 90s was there was a lot of speculation over tech stocks. It was a very overhyped sector. Everyone and their dog was aping in, thinking the internet would be the latest and the greatest thing. And this resulted in tech stocks and internet stocks trading at massive overvaluations to what they were actually worth, pricing in future growth beyond belief. And that ended up resulting in the bubble popping. When economic terms started to weaken after the bull market cooled off in the late 90s, what happened was these overvaluations were exposed, and eventually the bubble burst, and we had a massive recession. And obviously the NASDAQ was front running that recession with the bursting of tech valuations. And this lasted 8 months, but the NASDAQ actually dropped 71%, and the recovery took 14 years from that point. 14 years. The S&P 500 took 7 years. So this, not to be naive, is a bit of an indicator as to how long recessions can actually last. 14 years is a long time. 7 years is a long time. Now, if we have to brave 14 years now, I think I just might cry, because that is a long, long, long time to slowly grind your way up. At least once you hit the bottom, it's mostly up, apart from this extended period in 2001. But it is still very, very difficult to, when you have a recovery actually that's that extended. And some critics have actually likened crypto's high valuations to tech stocks in the late 90s. Critics are very quick to point out that crypto looks bubbly and looks similar to tech stocks. I wouldn't fully agree, but critics will point that out. And I mean, in some altcoins, that is the case. Many altcoins, in fact, 90% altcoins go to shit and they never do anything. You're looking for that 5 to 10% when you invest. And that's where diversification comes in. That's why I preach diversification, because we can't possibly pick which L1. I mean, we got a good idea as analysts. We know kind of where the trend's heading, but we can't be for sure on the exact L1 that is going to win. So I like to take measured bets amongst multiple, and not just L1s, but also across the crypto sector in terms of key infrastructure that I think will be around in a certain amount of years. 2008. This was basically the worst financial collapse in history, or at least one of them. We all know what happened. If you don't know, there was a subprime mortgage crisis in 2006. Basically, the banks were holding assets that ended up being worthless. They were trading on derivatives, so they were taking out mortgages in the form of derivatives. Extremely risky stuff. They thought they were too big to fail. A lot of banks thought they were too big to fail. Investment firms, the Lehman Brothers went down. It was a great collapse across Europe, across America specifically, with the subprime mortgage crisis. Banks, hedge funds, insurance firms, everyone started experiencing liquidity issues. And then they were bailed out by Congress with a $700 billion bailout. And then there was almost $1 trillion economic stimulus package, which was implemented to avoid a global depression, because it was very, 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 very bad. And this lasted 18 months. The S&P dropped 55%, and the recovery took 4 years. So far, with the last 5 recessions, the recoveries took 15 months, 9 months, 14 years, or 7 years for the S&P, 4 years, and then 2020, which was the latest recession, took 6 months due to the crazy quantitative easing and money printing that took place post-COVID in order to stimulate the global economy. That resulted in a crazy V-shaped recovery, and it was a very fear-based drop, this COVID crash. Very, very fear-based drop. So what can we take in terms of the current recession and comparing it to previous recessions? Because obviously past performance isn't indicative of future performance, but it can give us an indicator into what we are in store for here. The first thing I'm going to say is we are trading on crazy boom and bust cycles at the moment. Never before in history have we been this volatile in terms of the Fed's monetary policy. And it's getting worse and worse and worse as the years go on in terms of these crazy periods of boom and money printing, and then these crazy periods of panic, bust, where money's taken out of the economy. And we're kind of trading on these cyclical periods, which in the past were taking 5 to 10 years. So in the past, a period of contraction would be multiple years. A period of growth would be multiple years, if not decades. Now they are trading on 3 month, 6 month cycles. It is bang, bang, bang. Things are switching basically overnight. It's pretty crazy policy. Why is this the reason? Well, just quickly as a disclaimer, I'm not a macroeconomic expert. I'm very interested in macroeconomics, so it's something I research. But my explanation to this is actually probably political. We know how politics work. We know that we've got midterms coming up in November. We know that the periods of power are very small in politics. So governments, they obviously need to retain the approval of the people. Now, the approval of the people isn't going to increase if you spur on a recession. Certainly isn't going to increase if everyone is losing their jobs, and it's certainly not going to increase if your wages are being cut and if you can't afford groceries. So they are incentivized now, since we went off the gold standard in 1971, to keep the economy growing. Now, unfortunately, we are now in a predicament because we are off the gold standard, because we basically changed the games, we changed the rules of monetary policy. Dollars are now essentially just a bet on the government. They are no longer redeemable for anything tangible. Since we've changed the game, we know the government is incentivized to do one thing, and that is keep the economy growing, keep equities increasing over time, and they have a vested interest in doing so. Now, because they have a vested interest in doing so, they are very unwilling to experience long periods of contraction. Long term, this is going to blow up in our face, most likely, because things don't last forever. The music can't keep playing forever. But we do know that with this approach, it will inevitably lead to higher priced equities. And that's why we're in crypto, because we know this is the system we're in. And we know if we're playing this game, we just got to play it. We have to be a player as well. We can't fight the system. And if the government wants higher equities, then if we have exposure to those assets, then long term, we're going to be the winners. Short term, this can result in some crazy swings, as we've seen from this boom or bust approach. The Fed is very stuck right now. That's just my take of the situation. And 1971, I think Kyle shared a website. It's called What Happened in 1971. Basically, the most damning website I've ever seen. It basically went to show that every single shift in terms of discretionary income, employment, GDP, every major data set shifted in 1971, coinciding with us going off the gold standard due to the Nixon's government approach. And it's kind of crazy, basically meaning that US dollars right now have no tangible backing. And they haven't for many, many years, but it's getting worse and worse because in the past, they weren't as willing to just print money willy-nilly and implement QE than they are now. Now it seems like it's just so short-sighted and it's purely political and it's very quick cycles, boom and bust. To be honest, no one really wants that. I don't know about you, but I don't really want boom and bust. I'd rather a little more stability. I'd rather not have 2 years of 10x's and then the next year we drop 99%. But that seems to be the market we're in right now. And it's quite a shame. But Bitcoin does go to solve that, by the way. That is a major plus to Bitcoin. Now, it's not there yet. It's not actually an inflation hedge yet. And it's not a store of value yet. But it actually is potentially an out from this financial system. So we can't be remiss of the fact that Bitcoin's technology has the capability to solve some of these fundamental flaws in the current monetary system, which gives us a lot of hope as Bitcoin as an asset. Unfortunately, right now, it still trades on speculation like a tech stock. One day, I think this will change. That is why it's 23,000. It wouldn't be 23,000 if it was a tech stock. It's 23,000 because people have the hope of one day it does become a store of value / inflation hedge and potentially, is adopted by many nation states as a tangible form of currency with the Lightning Network. We can pay using Bitcoin. And overall for Bitcoin, it's not actually a terrible thing. But in the short term, we just got to play these cycles. But in past recessions, if you'd invested just during quarters of negative GDP growth, taken profits when GDP began to recover, you would have made an average of 31%. So often it's too late by the time you wait for the recovery. So this is an indicator that DCAing during recessions are a good idea. So you guys, as long-term crypto investors and stocks, have to consider what your DCA plan is. If you're not DCAing, now I don't think there's any necessarily reason to FOMO in. In fact, I don't like FOMOing in after massive pumps. On the dumps, as like this area would definitely be the area to buy. However, you do have to start considering the fact that you can't actually time the bottom. As much as everyone on crypto Twitter loves to tell you that they're the greatest trader ever and they can time the bottom, not even the best investors in the world can time the bottom. Warren Buffett doesn't time the bottom. Ray Dalio doesn't time the bottom. I honestly have no interest in timing the bottom. If I get close, cool. And the local bottom is likely in. But in terms of the stock market and the GDP bottom, which is obviously extremely correlated with equities, this is what it looks like in terms of how quickly things can actually reverse. And by the time things start rising, there's a major opportunity cost now. Now, the big caveat is picking the GDP bottom is an arbitrary measure. It's very hard to do. GDP bottom may not be this quarter, it may be next quarter, maybe the quarter after. But I think the best way to combat this is to DCA in all quarters of negative growth, because eventually that has been a tried and tested strategy to come out the other side ahead from a dollar cost averaging perspective. So Gareth is spot on. The markets are liking this news. I still don't think we should gloss over the fundamental macroeconomic detriment of what a recession causes. I alluded to it before. In terms of unemployment, in terms of the lower class, it is obviously not good from the perspective of the entire economy, especially if you break it down into segments. But for equities, this does provide a little bit of relief in the short term, although a lot of people didn't think it would. It is. And now we have a little bit of headroom. With the FOMC in 55 days, major earnings, I say almost behind us because I tweeted this last night. You can cover that up because they now are behind us. All the major earnings basically have reported. It feels like we have headroom for the first time in a while. And let's just have a sigh of relief because it's been a big week. So let's all relax and look forward to August. Now, August could be a very, very strong month. Now, I do think we are showing the signs now of an extended rally. I do think 24 isn't the high for this local top. I do think there's a strong chance we push to 28 to 30. That is just me being completely honest. If I'm wrong, I'm wrong. I have my stops in place just in case that is invalidated. But I'm trading on the presumption, or at least starting to plan for the presumption, that a 28 Bitcoin is very, very, very possible. New lows could definitely come towards the end of the year. They could definitely come at the start of next year. But I'm kind of trading August as a separate little entity with FOMC 55 days away. So on the Bitcoin chart, you definitely don't want to be FOMOing in now. I'm kind of waiting for a little pullback here. I'm hoping for a little reversal. I want to see where things settle a bit. I don't think we just explode to 28 today. I think, we can push up, do this again, kind of play these games a little bit and start to do something like this. Like the market will want to shake out the weak hands. The whales are loving the manipulation at the moment. Very manipulatable market. Come back, retest, and then maybe look up at a push towards 28K. That's just a scenario I see playing out. Worst case would be we actually come back down again. People start panicking. Very, very possible that we have a steeper contraction. That's just a game we're going to have to play in the short term. Basically, all signs allude to not longing right now on Bitcoin. Not that comfortable. Although the DXY is breaking, I'd still love a daily close under here. We've only gotten one close actually on trend. I'd love a daily close under. That would make me a lot more confident in terms of longs. And then some of these altcoins, that was, by the way, that was my entry last week. Like, are we spot on or are we spot on? That's like brilliant. Solana breaking out, approaching resistance. Very hard for me to long that, to be completely honest. Phantom, I mean, it is technically bouncing off the horizontal resistance. I mean, the real risky scalpers would be longing this, setting a stop here. But that's like such a tiny scalp, it's almost not even worth mentioning. You've got Matic just pushing higher and higher. Matic has the narrative breaking above this diagonal again and testing support. This does look bullish overall for some of these altcoins. But the reason I don't quite want to long is because we do look a little bit overextended on some. For example, AVAX looking slightly overextended. Mana looking slightly overextended. The RSIs are starting to tick down. And then you do have the confluence of Bitcoin, which is approaching resistance. So I'm never going to long into Bitcoin resistance on the alts. And I also need to see this kind of come up a little bit more to verify any shorts. But I'm not that interested in shorts right now because I think August is a good month. So I'm more gearing my trades towards how can I get enough long entries without getting stopped up to take advantage of the upside potential of August without wrecking myself for capital or liquidity in the meantime. That is a trading strategy. Obviously, the DCA is out there. DCAing, the plan doesn't change. August is the same as July, is the same as June. We're DCAing all throughout this recession, at least I am, in order to get our average entry price on assets we believe in long term. Now, this obviously means you're only investing in assets you're going to think are going to be around to the next cycle that have strong narratives. Having all your money in L1s, that's not a great bet either because the L1 narrative was last cycle. Now, of course, L1s power ecosystems. They power DeFi. They power large sectors of crypto. But we can't have all our net worth concentrated in these L1s. We know that it's an extremely competitive landscape, and I think it would be unwise to do so. So they are key pieces of infrastructure. There's exchanges like GMX and DYDX. There's bridges like Synapse. There's the Ethereum play, so Ethereum, Matic. You've obviously got the L1 players. I won't talk about them because we all know what they are. You've got L0 players like DOT. You've got ecosystem plays. You've got NFTs and gaming, NFT staking platforms. There's multiple narratives that we can actually go for here. And next week, that is the video where I'm going to go through my portfolio that I'm looking at. You've also got cloud computing. I mean, something not a lot of people are invested in, like a cache. You've got Internet of Things through Helium. There's some pretty cool projects, indexing protocols like the Graph. Like, I don't really want a full L1 portfolio anymore next cycle. I want to go for narratives which haven't popped. I would love to get the next gaming boom. I would love to find the next cloud computing software that at 100x or the next exchange. Like DYDX, by the way, is a fantastic investment for the exchange narrative. So I think we just have to think a little bit more outside of the box in terms of DCAing for next cycle. Although these top 20 assets are great, most of them, in terms of risk reward, I'm trying to be a little bit more adaptive in what narratives I actually pursue as an investor. But that is something we will dig into next week with watch lists. I know you guys love watch lists, DCA plans. I think it's pretty important to go through. So we'll do that next week. I told you in terms of trading, we are now looking like August has got some serious headroom. So here's to hoping, fingers crossed, that it is a bullish August. And I want to discuss this further on my Instagram now. So I can actually answer some questions. Darren just says quickly, how is it that we only hear how well you did every day trading? Nothing wrong with sharing bad trades. 100% Darren. I'll share bad trades. Like yesterday, I took some scalp shorts that were, to be honest, pretty smart. Like I took them, now very risky. I took them pre GDP numbers. I was printing. I was up like 30-40% on Ethereum. I was greedy. I was going, no, we're going to go down to 1500. We got to like 1510 and I didn't get it. And I got stopped out at entry when I could have made, a lot more. I could have made 30-40%. That was, in my opinion, a bad trade because I got greedy. That was yesterday. To be honest, I'm on a decent streak. I'm not going to lie. I had a bad streak a few weeks ago. I'm on a decent streak. We go through streaks as traders where the logic starts to line up a little bit, where things go well. I think things are starting to go okay for me at the moment. I don't want to jinx anything from a trading perspective, but I'm certainly improving as a trader, so that's been great. But yeah, I definitely share bad trades, but I share it all on Insta, bro. Like, I'm very transparent. I show my ByBit on Insta. I show how much I'm putting. I'm extremely transparent with that. So yeah, definitely good to learn off our losses too. Exactly. We have bad streaks. We have good streaks. It's important to take advantage of the times where you're hot and you're performing well and your logic's spot on. And then when things aren't going so well, sometimes it's time to just cool off a little bit. Take the gas off the pedal. Take a couple days off trading. Like, day trading is not something we want to rush. Day trading is something, if you are doing it, then, you only want to take those entries when the time's right and when you're in the right headspace, because it's very easy to screw up and make mistakes trading when you're in the wrong headspace, when you're chasing something that isn't chaseable or chasing or revenge trading losses. So yeah, I'm live on Instagram right now. So anyone that wants to continue, ask any questions, trade live with me, or at least we can go through some setups, make sure to head over to Instagram. I do follow some people back that joined the stream, so I'll be following some people back now. For following me, showing me some love. And yeah, let's get straight over there, because I'm excited to go look at some charts and dig a little bit further into what I'm seeing with some of these altcoins. Hopefully Sounds Tricky joins me as well. He says he's at a doctor's appointment. We trade together and we have quite a nice confluence between our trading styles right now. I'm almost at 10K too. So if we could get me to 10K, please, that would be awesome. That would be really, really cool. Then I get those lovely little swipe up links on the story. So that'd be cool. We're almost there. So yeah, I will see you over on Instagram. Next stream's on Sunday with Sounds Tricky. We're doing a DGen's Den, as far as I'm concerned. We've got a 21st on Saturday, so as long as I'm not too dusty on Sunday, that's going ahead as planned, and that should be a lot of fun, and we'll do some live trading there as well. But thank you guys for joining me. I will see you in the next one. Peace out. On YouTube, as most of you came from.